Let's talk about subsidies tonight. Nigeria is on a collision course to the public because the government there has announced plans to cut subsidy spending by 90%. In Angola, subsidies are being scrapped altogether. So finally, the gospel of subsidy addiction is actually getting out the window. But of course, from a political perspective, it's still very much a problem. We'll be finding out how African crude oil producers will be coping moving forward in this edition of Global Business Africa. Thank you for watching. I'm Ramanyang. Here's what's coming up. Senegal's taking radical measures in order to boost its ailing tourism industry. We'll tell you what they are. And we'll be looking at the story of a profitable enterprise that's producing mushrooms for export in Rwanda. Let's start in Angola. The government says it's planning to end petrol subsidies and to increase the price of other fuels, as last year's drop in oil prices has, to put it mildly, savaged state finances. Angola is Africa's second largest crude oil producer, but it imports most of its fuel due to a lack of refining capacity. Pretty much the same story with Nigeria. Global consulting firm Control Risks says the government spent roughly 4% of its 2013 budget on fuel subsidies. In February, Angola slashed its spending for its 2015 fiscal year, widened its fiscal deficit projections, and then said it would sharply increase borrowing. Now, the government says gasoline will join the free price system in September this year. The price of diesel will also go up by 25%, although the state will still subsidize roughly 21% or so of its total cost. Nigeria, on the other hand, will be cutting petrol subsidies by 90% this year because government revenues, pretty much the same story with Angola, have also been hit by the drop in oil prices. The government there hopes to phase out fuel subsidies, which have been a significant burden on public finances. But that in turn could aggravate the current fuel crisis in the country. Major cities have been hit with petrol shortages as oil importers continue to strike over unpaid government subsidies. Parliament approved a reduction in subsidies to just over $500 million for 2015, according to the Finance Minister, Ngozi Okonjo-Iweala, late on Tuesday. The country tried to cut subsidies 3 years ago, but that move triggered days of protests. The government later reinstated part of the subsidies in order to end those strikes.
Bigger refineries are expected to come on stream. Example, the Dangote. The previous administration granted 20 private sector licenses to refine crude. None of them has taken off as yet because they are looking for finance to set up small modular refinery costing about $100 million for 20,000 barrels a day. From the perspective of the incoming government, there needs to be a bigger debate on this, national debate, which would actually call for restructuring of the entire industry, oil and gas industry, to ensure that if resources can be released by releasing some of the equity that the federal government has in the oil sector, that could be used to restructure the entire industry so that we can kiss goodbye to this perennial problem of fuel scarcity.
Now, we'll be live in Lagos in just a bit, looking at the question of fuel subsidies moving forward and, of course, the political landmine that is. But right now, let's head over to the UK. Voting, of course, is underway in that country's closest general election in decades. Roughly 50 million people across the country are eligible voters. Polls open on Thursday at 7 in the morning and the local time, and they will close at 10 p.m. People, of course, are voting for their representatives in the country's parliament. The next prime minister said to be from one of the two largest parties at the moment, the current incumbent, David Cameron of the Conservatives, or Ed Miliband from the Labour Party. Now, polls do suggest that neither one of those two parties has the required support of voters for an outright win and therefore a parliamentary majority. Analysts argue that the election should dramatically reshape the UK's relationship with the EU. Currency patterns for both the pound and the euro might be disrupted as trading relationships could be thrown into doubt, and of course economic policy as well. Exit polls will be released as polling stations close, with most results set to emerge overnight, although the final tally of seats will not become clear at least until Friday afternoon. Let's get the latest now from Kelly Lemon. She's live in London. Kelly, what's the latest on the election so far?
Well, as you say, it's too early to say at this stage, as voters still have a few hours left to head to the ballots. We're expecting about 19 million people to vote today, which is about 12% more than the last election. Now, all the leaders are urging for support, as the Prime Minister describes it as the closest election for a generation. Polling stations close in just under 2 hours, and then the task of counting the votes will get into full force. Now, journalists will be on standby throughout the night, as we expect to see results trickle in during the early hours of tomorrow morning. There is a huge speculation we'll have a hung parliament, and this may well go down to the wire, and it will take longer to get a clearer picture of how the UK is voting.
Indeed. Give us what perhaps we should describe as an idiot's guide to the UK's election. Given how close run these elections are, do we know who either one of the preferred coalition partners for either the Conservatives or Labour would be?
Well, pundits aren't expecting a majority in this election, which likely means a coalition. Now, the Conservatives have already said that they're happy to negotiate with any party except the SNP, and many experts are confident the Scottish National Party would not leave the decision-making of the UK to number 10 Downing Street if they were elected. In fact, analysts say we would only see a coalition with the SNP if the Labour Party wins a minority. But at this stage, we're seeing that a lot of deals and negotiations are still being done, and we expect a lot of that to happen in the coming days.
Indeed, we'll leave it there for the time being. Thank you for the update. That's Kelly Lemon live in London. Fairly extensive team up there, of course, covering those elections. Fairly interesting ramifications will come through with regard to the economic relationship between the UK and Africa moving forward as well. Now, let's head over to Lagos. Deji Badmus is live over there with a little more detail, of course, on what you should expect to come out of Nigeria. Deji, the last time the government tried to cut subsidies on fuel, this was way back in 2012, there were street protests for 8 straight days. Isn't the same outcome likely this time round? And how will the President-elect, Muhammadu Buhari, respond?
Well, thank you very much, Rama. There's no question that this is going to be a very difficult issue for President-elect Muhammadu Buhari to crack when he comes into office. There's still no conclusion yet that the government is going to remove subsidy at the end of the day. What the government has actually budgeted for subsidy payment this year is actually 100 billion. That's what Parliament actually passed. But of course, as the minister explained a few days ago, it's obvious that the 100 billion naira would not be enough, and that the government would have to make provision for further subsidy payments. But then, this is surely going to be a very difficult issue for Buhari to handle. And given the fact that the unions, the labor unions in this country have all come out to say they are not going to accept any form of removal at all. But then some people have said the government made a mistake by not completely removing subsidy when oil prices fell to as low as $40 per barrel. That was the actual time the government should have removed subsidy. But what the government did at that time was just to reduce the price of petrol. And now that oil prices are going up, it's going to be a very difficult thing for the government to do. Removing subsidy completely would surely be a difficult one for Buhari.
Indeed. Let's step back a moment, though. Nigeria's public finances, as we heard a little earlier in the week from the finance minister, are extremely tight. Walk us through how we got to a point where the federal government, and essentially Africa's largest crude producer, has to borrow in order to cover recurrent expenditure.
Well, Rama, the simple reason is this: oil prices. Oil prices fell, and we're talking about a country whose, the source of government, the bulk of the government revenue actually comes from oil, and is a major source of Nigeria's foreign exchange. And so when the prices of oil went down, Nigeria began to suffer. Now, the question is, why did Nigeria begin to suffer? Simple. We did not save enough when the price of oil was far above $100 per barrel, when it was, say, for instance, 140, 137. At that time, we did not save for the rainy day. We did not save enough. Now, I know that at some point in Nigeria, we have what is called the excess crude account, apart from the Sovereign Wealth Fund. The Sovereign Wealth Fund actually took over from the excess crude account. Now, the excess crude account is where the excess amount of money we make from the sale of oil is supposed to be paid into. I know that sometime in 2013, towards the beginning or towards the middle of 2013, the amount of money we had in that account was about $10 billion. But between then and now, that account has been depleted. And as we speak, the reason why the government is borrowing is just because there's no buffer at all. There's no saving. So there's nothing for the government to fall back on, nowhere to go to get the money. And so the government is resorting to borrowing. So people would tell you that we were not disciplined enough to save for the rainy day. The government did try to set up the Sovereign Wealth Fund. Of course, it did set it up. But then at some point, it got bogged down by this issue of some governors not supporting it, saying, look, you don't have to save for the rainy day because the rainy day was already here. So the governors were advocating that the money should be shared. And that is why we're facing the problem we're facing today, Rama. I mean, just take a look at a country like Saudi Arabia with a sovereign wealth fund of about $600 billion. That's a huge buffer. So even if the price of oil were to fall to as low as $20 per barrel, Saudi Arabia wouldn't have a problem. But for a country like Nigeria, where you don't have that kind of buffer at all, this is what we're facing. This is the consequence of not being able to be not being disciplined enough now to save for the rainy day, Rama.
Indeed. Subsidy arrears, that's been quite the hot topic in Nigeria, given the fuel crisis at the moment. OMCs were paid earlier on in the week, but given this current cash flow crunch and the state of public finances right now, isn't this just going to be a recurring problem, month in, month out, year in, year out?
It definitely will be a recurring problem. Now, let me just tell you something. Just early this week, the government paid part of the subsidy it is owing the major oil marketers. Now, the major oil marketers came out to say they were being owed $256 billion, billion naira, I should say. Eventually, the government was able to pay around 150 billion naira. You still have an outstanding of around 100 billion naira. Now, even the government, too, has not been so open in terms of how much it is owing this major oil marketers now when it comes to subsidy. But the issue is this. As we speak today, Rama, the fuel scarcity is biting harder. And the simple reason is just because...
Oh dear, it does seem we've lost Deji Badmus in that link to Lagos. We do apologise for that. For the time being, though, quick run through the markets. Let's see exactly what's happening across the board. We've been seeing quite a bit of a correction settling in across the board, and today is absolutely no exception whatsoever, despite, of course, the rather stellar results that we did see coming through from Safaricom, about $300 or so million in after-tax profits. That's roughly half, actually more than half, of what Nigeria plans to spend subsidizing gasoline in this particular fiscal year. So that should give you some correlation of exactly just how big that amount of money is. But its share price, of course, did close in the red in trading today. Coming up next, there will be tough negotiations ahead as the National Union of Mine Workers in South Africa makes its pay demands. And we'll also be in Senegal, where the country is taking radical measures to boost its ailing tourism industry. Africa is on the move. It's home to 7 of the world's 10 fastest growing economies. We help you make sense of the fast-changing African business landscape. We take you where the business is happening.
Global Business, weekdays at this time on CCTV Africa.
This report by the African Green Revolution Alliance says climate change will slash food output. Within the next 30 years, the number of malnourished people in sub-Saharan Africa could jump nearly 40%.
Welcome back to the program. You're still watching Global Business Africa. Now, let's take you to South Africa, where the National Union of Mine Workers, it is predicted, will be demanding a 75% pay hike, at least for entry-level wages, in miners, or for miners rather, in the gold sector. Union sources anticipate that wage demands for entry-level workers will be announced sometime next week. These demands are expected to be high, and they are also expected, therefore, to lead to fairly tough negotiations in mining companies and potentially a protracted dispute over pay. Company profits in the gold sector have been under pressure in recent times with a fall in prices for the precious metal. Kelly Lemon spoke to Barnaby Fletcher, an associate analyst at Global Risk Analytics, on the union's prospects.
We haven't seen much in the way of official response from the mining industry or any major developments in the negotiations, and this was largely expected. Firstly, the substantial difference between the 75% wage demand that the National Union of Mine Workers plans to ask for and what mining companies are likely to be able to afford is quite substantial, and this obviously complicates matters. But second of all, both the union and the mining companies are concerned not only about what they obtain, but about the perceptions of the negotiations. On the part of mining companies, they want to put forward a figure which is realistic, but also beyond which they can plausibly claim they'll have to implement cost-cutting measures which could impact on jobs.
And what's the worst-case scenario in terms of these wage talks?
Well, the worst-case scenario, if you look at AMCU, which is NUM's main competitor, they launched a record-breaking 5-month strike in the platinum sector last year. And their willingness to strike is driven by a need to gain more members, to attract more members, and therefore gain a better deal, more concessions from mine operators than NUM. So obviously the worst case scenario is that MUM engages in a similar prolonged strike action. However, at Control Risk, we do feel that this situation is unlikely. The circumstances around the 5-month strike in the platinum sector are very different from the gold sector at the moment. For a start, AMCU was a young, ambitious and quite militant union that was eager to differentiate itself from MUM, which it criticized for giving in too easily to mine operators. And second of all, tensions in the platinum sector at that time were already very high because little over a year earlier you had the Maracana incident where 44 striking workers were shot by police. NUM are probably unlikely to engage in a similar protracted strike simply because it would be very difficult without that existing tension to persuade their members to engage in such a long strike period, during which, of course, they are not receiving their wages.
And how are investors now viewing long-term mine projects in South Africa?
There is definitely still potential in South Africa. It does, after all, have arguably the best financial sector, the best infrastructure, and world-class mining service companies in the continent. But we are seeing less and less interest in Control Risks in new investments. And this is partly due to the problems, well-known problems in South Africa, the trade union issues, problems in the energy supply, and legislative uncertainty caused by the government. But it's also due to the competition that South Africa is facing. If you go back not more than about 5 years, South Africa accounted for over 50% of production for about 7 of Africa's 10 biggest mineral commodities. This is no longer the case, as other mineral jurisdictions in Africa not only sort out their infrastructure and their legislative frameworks, but also demonstrate their political stability through successful democratic elections. South Africa is increasingly having to compete with them for what is actually quite a limited pool of global financing at the moment. Unfortunately, South Africa is simply not adapting to that increased competition.
Over in East Africa, Kenya Commercial Bank has retaken a position of being Kenya's most profitable lender. There's been a back and forth between KCB and Equity Bank on this one. First quarter profits for KCB, before tax, of course, were up by 12%. KCB recorded a first quarter gross profit of about $65.5 million. Those results will see it overtake its competitor, Equity, which announced $64.69 million in profit for the exact same period. KCB has slightly higher interest income fees and commissions arising from new business lines as key profit drivers. Now, the group's total assets increased by 24%. The institution is now focusing on growing its mobile banking sector as a future revenue earner.
more than 4 million transactions are happening. Almost today, if you look at that in 3 months, it's more than 1 million customers a month. We are almost reaching 1.4 million customers a month on mobile alone, which gives you the size of the transaction you're looking for. So that's one of the areas that the bank will continue to grow.
Joshua Oigara, the CEO of KCB there. Quick run through commodity prices here for you. The numbers, of course, usually make for interesting reading, but the story around them is equally interesting as well. News out of South Africa today. South Africa apparently will be gazetting final regulations for shale gas exploration by June. 2 years, of course, after releasing draft rules. Companies, of course, had reconsidered investments into that particular sector. We'll cover this in a lot more detail later on tomorrow. Also expect Lonmin to be cutting a couple of jobs due to the fall in the prices of platinum. Coming up next, we'll be looking at the story of an enterprise that's producing mushrooms for export in Rwanda.
Africa is not one country.
And Africa is not one story.
But as Africans, we do share one belief.
One more offensive in a row.
That whatever the challenge, we will overcome.
CCTV Africa brings you unrivaled coverage.
From the fight against Ebola to the fight for greater freedom.
From the figures seeking your vote to the figures shaping your economy.
This is Guy Henderson reporting from the jungles of East.
And all the reasons to celebrate the diversity of life on this great continent.
Twenty minutes into the hour, you're still watching Global Business Africa. Now, China might be the largest producer of mushrooms, with roughly 70% or so of global production. But the crop still offers valuable new income opportunities for East Africans. One Belgian entrepreneur is empowering Rwandans to grow this crop and develop a global market for this edible fungi. CCTV's Rebecca Bowring reports.
Laurent Demonque is back at Stanford University in California and the business school he graduated from in 1995. He's here meeting with students interested in creating innovation in developing economies. It's a cause close to Laurent's heart. A former investment banker, the Belgian native is now tackling malnutrition in Africa with a social enterprise that's also profitable. 5 years ago, he founded Kigali Farms in Rwanda and has introduced some 500 local farmers to growing oyster mushrooms.
They have all the good protein, 30% protein, dry weight. They have all the essential amino acids. They have iron, zinc, vitamin B and vitamin D. Very rich nutritionally. They help build up the immune system. That's why I like them.
The mushrooms are not well known in the rest of the country, but they don't take much space to grow, and they have all the necessary proteins we need in good food.
Kigali Farms produces what's called high-yield substrate, the organic material used for growing mushrooms, which farmers can buy. They then sell their crop back to Kigali Farms for distribution or onto their friends and neighbours. Laurent says the return on investment is around 40%, far greater than that for potatoes or maize.
On very little land, something like 50 square meters, a farmer can make $1 a day. That's totally meaningful income. Most of them, like 80% of manual labor, are women. Those are women that before we came along didn't have a job.
Mushroom farming is ideally suited to small landlocked Rwanda with its humid climate and poor soils. And agricultural waste, such as wheat straw, is put to good use, feeding the fungi. Laurent says he's continuing work begun about 15 years ago by the Chinese Cooperation Agency.
They work with rice, of course they work with bamboo, and then mushrooms. And they've taught a lot of people to produce the mushroom spawn, to produce the mushroom substrate, and to help them to grow mushrooms.
Locally, Kigali Farms has been spreading the word about the benefits of a mushroom-rich diet. It's also luring in customers with new products like this powdered meat rub. Kigali Farms wants to expand its reach and start exporting. Its team is in talks with major supermarket chains in Uganda and Kenya, looking to sell its dried and powdered mushroom products in new African markets. Rebecca Bowering, CCTV, Stanford.
Now, Sudan, in the meantime, is looking to expand its gold industry and eventually become Africa's top producer of the commodity. The country's mineral minister said the country expects to produce about 76 tons of gold this year. That should be way higher than last year's production. Sudan has been struggling after losing 3/4 of its oil output in 2011, when South Sudan split. Oil, of course, at the time was a main source of foreign currency earnings, and it did provide quite a bit of support to the Sudanese pound.
Sudan plans to eclipse South Africa and Ghana as the continent's top gold producer. That's according to the country's Minister of Minerals. Muhammad Sadiq Al-Khoury did not give a time frame for when this would happen, but emphasized Sudan's growing gold production. It more than doubled last year to a record 73.7 tons, generating revenues of about $3 billion. Half of that reached state coffers.
We produced 25 tons of gold in the first quarter of this year, and at this rate we will exceed 80 tons, but our target was 76 tons. The production will be more than we expected, and in the future we hope that we can become the top producers of gold in Africa.
South Africa's gold production output has been declining for years. The country's statistics agency said gold production in the first 3 months of the year had fallen by almost 6%, while Sudan sits on what could be Africa's largest gold reserves. But a US trade embargo in place since 1997 deters most Western firms. Despite that, more than 60 foreign companies operate in Sudan's mining sector, including companies from China, Russia, Canada, and the Arab world. Gold mining is key to government efforts to keep the economy afloat after losing 3/4 of its oil production when South Sudan split off in 2011.
The exploration of gold after the South Sudan secession in 2011 was a blessing for the Sudanese economy and contributed in bridging the gap in hard currency. Considering that the oil was representing 90% of the country's exports, and after Sudan lost the oil revenues, there was a big gap in the balance between imports and exports.
The minister blamed sanctions for choking the mining sector by hindering the import of advanced machinery and preventing money transfers in and out of the country. But he said Sudan would establish a minerals exchange within a year, with participation from neighboring countries. He offered few details about the project. Valdi Carosa, CCTV.
Right then, let's wrap up with a look at the currencies. Today's story is pretty much all about the Kenyan shilling. It's at 3.5-year lows, around 95.13, 95.40, and that's on the interbank side. The retail rates are a nightmare unto themselves. Two things of note, however. The central bank did put out a circular essentially banning trade with brokers, and that in turn has made price discovery relatively difficult. That's partly contributing to the slump you're seeing there. But at the same time, remember, there's a leadership vacuum at the Central Bank of Kenya. We don't have a governor in place yet. The deputy is still running the show. We'll leave you there for the time being on this edition of Global Business Africa. As always, please send your feedback, your thoughts, your ideas, your story pitches, good and bad, to Global Business Africa at cctv.com. And of course, Facebook and Twitter are also your ports of call. The news continues over there 24/7. I'm Ramanyang. See you in 23 hours.